Ladies and gentlemen, welcome to Entrepreneurial Finance, Exit of Business Ideas. So, how to exit a firm? If you have an equity investor, especially venture capitalists, but all other investors too, equity investors, these investors normally have a business model buying shares, selling shares, buying low, selling high. Having said that, there has to be the day when someone sells shares. So there has to be some kind of exit. If it's an exit for the whole company, for every shareholder, at least parts of the company, there has to be an exit. And this is what exiting is about. Let's take an example, Meraki. Meraki was founded by MIT PhD students, and actually they did products, services for cloud-controlled Wi-Fi. And it was founded and was financed by Google Ventures on the one hand and Sequoia Capital, very many interesting companies, by the way, on the other hand. And later on, after this company developed very, very well, this company, Meraki, was sold. Actually was sold for $1.2 billion to Cisco. So Cisco acquired that company. And what happens in that case is, and this is a very typical trade sale, that all the investors before they exited the company, because Cisco was taking all the shares these guys had, and they were able to cash in some money for this exit. This cash in is the financing round before. So this is how an exit normally works. So if you have venture capital in your company, you have to write such a story. Maybe you can't do the 1.2 billion sale. However, you have to make some kind of sale in order to be able to let that your venture capitalists, your equity investors are able to exit, because the funds are not built forever. The funds have limited time duration. So now, what are interesting and what are the relevant exit mechanisms? What are the relevant buyers? What is the right timing for that? Looking at that a little more closely, start with the buyers, and I would like to go into the buyer structure a little more. You have basically two sorts of buyers, financial buyer and strategic buyers, plus the public if you do an IPO. But in most cases, you can consider the public also to be financial buyers or behaving like financial buyers, because most of the people buying shares on a stock exchange, they want to have financial returns, dividends, and higher share prices. The second thing you look at is the timing. Is the timing right to exit your company? What about your own performance? What is with your equity story? Is the market still there to make an interesting equity stories? Also for the guy who buys you, or for the potential buyer, and is your operation in place? What you can't sell, for example, is companies that do not have a proper management, especially if you think not of young startups but of mid-sized companies. When the firm owner gets 60 or 70 and he wants to sell, but he's the only manager, then this company is really hard to sell because it doesn't have a proper operation or proper management. So that's the second thing you should look at. And the last thing is the potential transaction structures. So what we have seen with Meraki before is a typical trade sale. So you sell your shares to someone else. What you can do is you can sell shares, you can make it a cash deal, or you can make it a share deal. So you exchange shares. Making a share deal might also be considered a merger. But this is a typical trade sale structure. Then you have the IPO, which is the initial public offering. So your company is being offered to the public initially for the first time. Facebook in May 2012, for example, was initially offered to the public. So all the people who wanted could buy shares from Facebook on the stock exchange. That's the second structure. And the third structure is the buyout, where at least some part of the company or the shareholders is being bought out by new shareholders. Not necessarily all the shareholders, but at least parts of the shareholders. So let's first of all look at the potential buyers. If you differentiate the potential buyers, you basically have two, which is the financial and the strategic buyers. Looking at these two buyers, you can try to differentiate those in their behavior. And maybe we should start with the strategic buyers. What is the rationale for a strategic buyer to buy a company? Actually, rationale is he is the potentially best owner of that company. And how is another company the best owner of a company? In most cases, it is because these two companies, they have synergies. And by realizing the synergies, by integrating this company, you can strengthen the business of the potential buyer. So for example, if Amazon is going to buy or bought Zappos, Amazon is selling basically everything on the internet. They didn't sell shoes and clothing. Zappos was selling shoes and clothing. When Amazon bought Zappos, they also had shoes and clothing. They have a big customer base, meaning these customers also get shoes and clothing, and by that probably there are synergies on the top line on the sales. So Amazon is going to make higher sales, even higher sales than Zappos did before, because of the big customer base Amazon has. So that's typically the first synergies is always sales, so top line synergies, because it's a top line in the balance sheet or on the profit and loss statement. And the second is the cost synergies, which you normally might have. And in that case, if Amazon buys Zappos, they do not have need to have two IT systems. They can put all the IT into the Amazon IT, so they can save costs. By doing that, maybe Zappos, for example, made $5 million in profits. This is just an estimation. I don't know what the profits Zappos made before it was bought by Amazon. But when they made $5 million before, by reducing the cost, enhancing the sales, now it might be 10 million or it might be 20 million, which is a synergy which you can realize when you integrate that, and the best owner can best realize these synergies. So that's the reasoning for a strategic buyer to buy a company. For you as an entrepreneur, the most important issue is to understand why should someone buy you. What are the potential synergies you can use when he integrates your company? That's the one story. The other story is, why should a financial buyer buy a company? Actually, a financial buyer is typically a fund, so it's not an industrial player, and the fund doesn't have an own business, so the fund can't integrate something. So the only way to make money for a fund is buy low, sell high. And the only way to buy low and sell high is you see a so-called value gap, you realize the value gap, and after you realize the value gap, you sell the business again. And then you make more money. If a company makes 5 million, and you see the value gap of 5 million, and you have an EBITDA multiple of 5, company costs 25 million, and now you can realize the value gap. Afterwards, it makes 10 million profits, and you have the same multiple. It is a 50 million sale. So you made 25 million. Normally, it's not so easy to realize these large value gaps. Normally, value gaps are smaller. This is why normally these transactions are highly leveraged. And you can always leverage a transaction if you see that the value gap is higher than what you have to pay for debt. Then normally it's worthwhile to leverage a transaction. I mean, this always has... This is not possible to all extent. I mean, if you have 75% debt in the transaction, that'll probably enough, because then you risk too high interest rate, or at least you risk failure, because if the business doesn't go too well and you have to pay the interest rate, you might be bankrupt too soon. So the main reasoning for financial buyers is realize financial gains by identifying a value gap, realizing that value gap, and making money by selling higher, and especially making a higher equity return by leveraging your equity. So these are the two buyers, the potential buyers, and these two potential buyers can basically use all the transactions, but honestly, in most cases, a strategic buyer, that will be a typical trade sale, financial buyers, that will be a typical buyout transaction, and both buyers can typically go buy shares in an IPO.